Portfolio Construction and Risk Management, Chapter 11, Defensive Portfolio Strategies. Section 3, Bonds and Safe Havens. Bonds and other safe haven assets are there to do a very specific job. Help limit damage when riskier parts of a portfolio come under pressure. They usually give up some upside in exchange for stability, liquidity, and a better chance of preserving capital when markets get stressed. High-quality bonds often act like ballast in a portfolio, helping steady the ride when stocks become turbulent. In recessions or deflationary shocks, investors often move towards safer assets, and that demand can support government bonds, although the relationship is never guaranteed in every environment. It's important not to lump all bonds together. A bond's defensive value depends mainly on two things: the issuer's credit quality and the bond's duration. And those differences matter a lot when markets are under real stress. In a downturn, government bonds have usually offered the strongest protection because they pair high credit quality with deep liquidity. Investment-grade corporate bonds can still play a role, but credit spreads may widen in recessions, while high-yield bonds often behave much more like stocks than true defensive assets. Even very safe bonds can lose value when interest rates rise, and duration helps explain why. The longer the duration, the bigger the price swing, which is why short to intermediate-term bonds often fit a defensive role more comfortably, while long bonds tend to work best in falling rate or deflationary shocks. Defense doesn't have to come from bonds alone, because different safe havens protect against different kinds of trouble. T-bills and cash help most with liquidity. TIPS can protect purchasing power, and gold or certain currencies may help in inflationary or geopolitical stress, though each brings its own trade-offs. There isn't a perfect safe haven asset, only a set of trade-offs. Some choices offer more stability, some offer more income, and others do a better job against inflation. So the real question is, which risk you're most concerned about protecting against? A practical defensive allocation starts by naming the threat clearly: recession, inflation, rising rates, or a need for liquidity. From there, many investors use high-quality government bonds as the core, add only modest corporate credit if they want extra yield, and then rebalance as conditions change rather than leaving the mix untouched. Consider a $500,000 portfolio built to absorb a recession scare rather than maximize returns. If equities fall sharply while treasuries rise and the other defensive pieces stay relatively steady, the overall loss can be much smaller, showing how defense can cushion a drawdown even when it can't erase it. The tricky part is that the same defense won't work equally well in every kind of crisis. Treasuries may shine in a deflationary recession, but high inflation can hurt nominal bonds, and credit stress can pressure corporate bonds, which is why investors sometimes mix in TIPS, gold, or cash. Most defensive mistakes come from reaching for something extra, usually more yield or too much concentration in one supposed safe haven. Good defense means staying disciplined, respect duration risk, don't assume all corporate bonds are safe, keep inflation in view, avoid overdoing gold, and rebalance after markets move.